To me, there's two ways to use debt. You can spend money you don't have, or you can invest money you don't have. So the first way is probably the way your parents warned you about, but today we're talking about when and how to use debt the right way. Okay, so what do I mean by debt? Today we're talking about borrowed money that comes with an interest rate and is typically used to gain control or possession of the things you want to buy without spending as much money out of pocket. So this applies to assets and liabilities, so things that make you money and things that cost you money. The key to using debt at the right time is all about the rate of return. Assets should have a positive rate of return as long as it is above the interest rate of your debt. And liabilities tend to have a negative one, which is just the interest that we were talking about before. So the question I ask myself before taking on debt is this: will I get a net positive return on investment or a net negative one? So let's get into an example to demonstrate what I mean. This is going to be a bit more math heavy than usual, but I think it is important for this example. If you've seen any of our other videos, you know that most real estate investors buy homes using debt in the form of a mortgage. So let's say you buy a $100,000 property with 20% down and your interest rate on your mortgage is 4%, leading to a monthly payment of $500. Your investment at this point is $20,000 and you're receiving negative cash flow. Your return on investment is going to be calculated by taking whatever you're making from this property minus your mortgage divided by $20,000. In this case, your return on investment is going to be negative $500 divided by $20,000. However, if you can rent this home and cash flow $700 a month, you're now getting a return on investment of 3.5% every month, and in a year you will have made almost half your money back. This means that the debt you took on is a good investment because you're getting a rate of return that is much higher than the rate that you were losing. So now you might be thinking that debt is only good for assets, but that's not entirely true. So let's do an example of buying a car, a new car, and we'll use less math for the people who prefer the more conceptual side of things. So let's say you want to buy a new car that costs $25,000 and you happen to have $25,000 cash to spend. If you buy the car using cash, then the money you spent is gone and now you own a car. Congratulations. However, let's say that instead you were to finance the car and put down $2,500. Now you still have $22,500 that you can use however you see fit. And yes, you'll pay more for the car now since you have an interest payment. However, if you can invest that difference and get a higher rate of return than what you're paying on your car, you're cash flow positive, meaning your return on investment is net positive, and you'll likely have an asset that will continue to produce income for you even after your car is paid off. So debt isn't inherently good or bad, it's all about how we use it. And another thing I hear often is to use debt only in emergencies, and I just want to touch on that really quickly. Debt is probably one of the worst things to use in an emergency, but I understand that that's typically a last resort. So choosing the correct debt for your emergency is what's most important if you end up in that kind of situation. And again, we can use our understanding of rate of return to evaluate what that might be. So if you need money fast, maybe you need to put that money on a credit card, but that is revolving debt and your interest rate is going to be 20% or higher. However, you know that you can get a personal loan or even refinance your home or one of your investment properties and get a better rate of return for yourself. So you choose to do that, and that means you'll have a lower interest rate and better terms, and you pay off your credit card with that money, and now you're working on paying that more manageable loan off from there. And this is another benefit of real estate investing that I don't think is talked about as much as it should be. Being able to pull money out of homes with favorable terms not only can help you out in emergencies, but it can also be huge for paying for big expenses like your child's education, or even just for making more investments, whether that's in real estate or stocks or somewhere else where you get a better rate of return. So if you want a video on some of those unspoken benefits of real estate investing, let me know below. Otherwise, I'll see you in the next one. Take care.